CEO Elon Musk's role in the Trump administration has grown rapidly since the inception of the Department of Government Efficiency. But with Tesla shares having one of the worst weeks since the election, investors are wondering if Musk's role in Doge is pulling him away from Tesla. For more, we're bringing in Cathie Wood, CEO and CIO of ARK Invest. Cathie, always great to see you. Tesla is still your top holding in your ARK Invest, ARK-K, as we like to call it. That's the ticker. And you know, we've got, obviously, Musk very visible in Washington. But not only that, Time Magazine put him on the cover behind Trump's desk as the sort of de facto president, if you will. Now, we have talked before, Cathie, about Musk's multitasking. But this is sort of next level, Cathie, in terms of where he is putting his attention. Is it a concern for you as an investor?
Well, it's interesting. We were on his earnings call last week, and I don't think I've ever heard him more engaged or more into the details, answering in detail analyst questions. So
that's funny that Cathie Wood points that out, because that is something that I have talked about on this channel multiple times. Elon Musk does not seem like a CEO that is not focused.
As I've said before, I think he's an amazing CEO in that he is a troubleshooter. He figures out where the pinch points are, the gating factors, and he goes right at them. And I think he's doing it very effectively.
I mean, at the same time, the stock has taken a big hit. I mean, he may be figuring out those points, but at the same time, we got a lot of reports recently about Tesla sales, being down, deliveries being down in places like China and Germany.
Yeah, what's happening is the Model Y, which is the largest selling car in the world, is going through a refresh cycle. And I can tell you personally, I went to buy a Model Y, and at the showroom, they said, no, wait, the whole thing's going to be refreshed. This was several months ago, and lo and behold, this is where we are. So I'm happy they told me that, and I think I understand why we're seeing sales lag here a bit.
And yes, that makes sense. Some people are obviously going to just wait for the new refreshed Model Y. But a point that I've made here on this channel is that you don't just go from mass production of one vehicle to mass production of a new vehicle on the same production lines overnight. You slowly wind down production of the Model Y, you stop it completely, and then you start new production of the refreshed Model Y. It doesn't happen all at the same time. You don't go from mass production of one vehicle to mass production of the next vehicle overnight. There's going to be some issues you have to work out, so on and so forth. And that, in my opinion, can help explain some of the drop in January we have seen in delivery numbers.
So what turns it around, Cathie? What's the catalyst that moves this stock higher?
Yes, a couple of things. I think they're going to come out with their lower cost car this year. So that will increase access to Tesla's cars. Elon's always talking about affordability, certainly working on that one. And then, of course, autonomous. We do think that Tesla is getting ready to launch its autonomous service. We know they will launch. They announced the launch in June in Austin. And the question then is, how quickly will they roll out to other cities? And we think it will be more quickly than many think.
And honestly, it seems like everyone on the conference call just said, oh yeah, that's not going to be happening this year for the robotaxi launch in June. I mean, Elon gave a specific guidance for June. And yes, the stock went up a little bit after earnings, but it has since fallen to the lowest levels we have seen since early December, really mid-November. And another part of the conference call investors really did not notice was the fact that Elon said that, yeah, they're going to launch in Austin, Texas this year, but odds are good that they're going to launch in many other areas in the U.S. as well this year. That just kind of went in one ear, out the other.
First was the concentration in the markets towards the Mag 6. I think after the fallout from COVID and the sorting out of the market, people have been scared and saying, they value cash very highly as interest rates went up. And they like to dabble in the larger cap. That's the safer part of the market. So that the broadening out of the market that we are expecting now should really benefit us. So the first headwind was concentration in the markets. The market is beginning to broaden out. We see that since the election. The second headwind, I mentioned it, was interest rates. We went through a shocking increase in interest rates, up 24-fold in little more than a year's time. All long duration assets were plastered by that, including bonds that are supposed to be the safest asset class. They had some of their worst years in history. So concentration, interest rates, and then the last headwind we faced, especially in early 21, as the COVID had bid up our kind of stock to incredible heights from a valuation point of view. We had to work or grow into that valuation. And in the yen carry trade period last year, so last July, August, what we saw our portfolios based on an adjusted enterprise value to EBITDA ratio drop towards a market multiple. We've worked with S&P to develop this index. So the valuation headwind is gone as well. So concentration, interest rates, valuation have turned from headwinds into tailwinds.
And this is part of the reason why I have a $900 price target on Tesla stock by the end of this year. And it's going to sound crazy to most people, saying Tesla is going to go up 250% from current prices this year. Now at $488 per share, that was only a 100% gain. So you're really seeing an opportunity right now in Tesla stock, I do believe, from falling from the highs of, again, $488 per share down to $361 per share. And it does appear to me that most people on Wall Street right now are kind of throwing in the towel on Tesla. They're saying, well, is robotaxi really coming? Are cheaper vehicles really coming? Is Elon going to buy TikTok? Is Elon and Trump's relationship going to sour because of the media's portrayal of Doge? People seem to be focused on all of the potential negatives and worries out there, but yet they're paying no attention to the positives, as Kathy Wood talked about in that clip, as I will elaborate on here next. Optimus. What about Optimus? I mean, Tesla is hiring 12 senior roles to essentially facilitate mass production of Optimus. Last I checked, that is good news, not bad news. Lower, cheaper priced Teslas. Wall Street is saying, show me. We don't believe you. Show me that's coming. I believe that's coming. Robotaxi. Again, Wall Street's saying, show me that's coming. And I believe that's coming along planned schedules in June. And likely, as Kathy Wood says, going to expand to other cities this year. Now, there's other positive things going on at Tesla, clearly. But I think the other side of the equation that's really going to help Tesla is what happens internally in the markets. See, with just the Tesla story, assuming all else is equal, Treasury yields do not come down, the deficit does not make progress in getting lower, the Fed does not cut rates, none of that happens that I'll discuss here in a moment. Then my Tesla price target would not be $900 per share. It'd be more like $600. Okay. Where I think Tesla is really going to excel and benefit from is lower inflation via lower government spending via Doge. And that's really at the heart of it, Elon Musk. Elon Musk is going to drive down inflation this year. And yes, there will be data points that do not suggest that, like the 1 year ahead expected inflation from the Michigan survey, okay, that came out on Friday. 1 year inflation expectations skyrocketed to 4.3%. They were expected to be at 3.3%. That was really skewed by Democratic respondents of that survey that have an average inflation expectation over the next 1 year at 5.5%. Most of that, if not all of that, has to do with scary headlines media is sharing about tariffs, what tariffs will do to inflation. We know that Mexico and Canada, their tariffs at least, are delayed by a month. China has 10% tariffs put on them, but that seems like the end of the story for China. I don't see there being additional tariffs on China at this point. Europe is probably next for tariffs coming next week. And could that freak out the markets? Absolutely. You've already seen Europe, though, start trying to make concessions towards Donald Trump. Europe, the EU, announced on Friday that they would lower tariffs on autos. Essentially, you don't have Ford and GM vehicles in Europe because there is such a high tariff. Well, Europe's trying to make some concessions there. And I think that's an overall good sign heading into this upcoming week. Now, leaving the tariffs out of it to some degree, with the policies that are going on in Washington and with Doge, these are very disinflationary. Now, hopefully they're not deflationary, because deflation is never a good thing. But as Doge is cutting back all of this wasteful spending, and yes, the government is laying people off, that we really have to see how that kind of works into the economy. Too many people get laid off by the government. That could definitely be an issue. The government has been one of the largest sources of job creation in the past couple of years. And I do think that'll overall cause the Fed to start cutting rates. I mean, you start laying people off in the government in big numbers. And yeah, I think the issue is not going to be inflation in that scenario. The problem could be deflation and a deflating economy. Now, it's way too early to say exactly what's going to happen there with any kind of certainty. But I can be certain in saying two things. Doge is making progress on inflation. Doge is positive for inflation. So Doge has cut a lot of government spending already. We can see via the US debt clock that Doge has already cut about $72 billion worth of excess spending. Now, as Elon Musk says, they're going to have to basically triple that to actually make some real progress. Okay, they're going to have to reduce government spending by about $3 billion per day, which, again, that's very disinflationary. The other side of the equation is the deficit and the irresponsible fiscal path that Washington is on. The reason 10-year Treasury yields have been so high, okay, is not because of inflation expectations. It's not because of what the Fed is expected to do. The Fed has cut rates 1%. The reason 10-year Treasury yields have been so high, and Fed officials have confirmed this, and the Fed Besant has confirmed this in recent days since I first made the video discussing this, is because of Washington's irresponsible spending. Okay, any asset derives their yield off of risk. Okay, Coca-Cola is never going to pay you a 10% dividend, an 8% dividend. It's just not going to happen because outside of any kind of huge crash event, right? Because I don't even know where Coca-Cola's dividend is at, but I'll tell you right now, it is not going to pay you 8 to 10% because it's not a very risky business. Okay. It's just not going to happen. People will go out and they'll buy Coca-Cola at a 4% yield, right? Or at a 5% yield, and it'll never get to a yield that high because it's derived off of risk. AT&T, for an example, will probably never pay you a 4 or 5% yield. It's probably always going to be 7, 8, 9, 10% because it is riskier by nature. Wall Street, the markets have said AT&T has bankruptcy risk in the future because of debt, because of the evolution in technology. Okay. The government on a larger scale is the same way. Okay. When there's more risk long-term for the government, Bonds price that in, yields go higher. And the risk is derived from government spending. As the government becomes more fiscally responsible, as Doge has really been a driving force in this, you're going to see Treasury yields fall. And that's going to be great news for Tesla, clearly from the affordability standpoint. Car loans and home loans and really business loans, any loans that happen in the real economy are derived from the 10-year Treasury yield. Because would you give me a loan at 3% for 10 years if you could get 4.5% from the government? Absolutely not. But if 10-year Treasury yields are 2%, you may give me a loan at 3% for 10 years because you can only get 2% from the government, which is deemed as risk-free, okay? That's, in essence, how this works. So bringing down 10-year Treasury yields does good things for the economy, for the lending market, but it also does great things for risk assets. If you can get 4.5% for 10 years, why take risk in risk assets? In which it's actually shocking that Tesla went to $488 per share with the backdrop of higher interest rates, because that just means people were taking on a lot of extra risk, if you will, on a risk balance perspective. Like, again, if you can get 4.5% 10-year Treasury yields and you're buying Tesla stock, I mean, that says a lot about Tesla, right? Clearly that says good things about Tesla, but it's not as appealing. Okay, so I think that's a big driving factor that we're going to see in the second half of this year is lower inflation, more fiscally responsible government that really is driving that inflation lower, and more of a risk on kind of aptitude towards stocks, which is really going to come at a perfect time for Tesla, as Tesla is launching the robotaxi network, as Tesla is really ramping up production of lower, cheaper priced Teslas, as Tesla is starting to mass produce Optimus for internal usage. FSD licensing deal will probably be announced by then. FSD will be in the Chinese and European market. You know, with all of that, I'm confident in saying Tesla's probably going to be a $900 stock by the end of this year. And what's actually interesting about this, in my opinion, is I don't think you're going to get multiple expansion here. Okay, but I do think you could get earnings growth, like a lot of earnings growth next year that is going to justify Tesla being a $900 stock. For an example, if you take a look at where Tesla stock is currently at today, and take a look at the EPS expectations for Tesla stock coming next year, we'll just go ahead and check out what the current expectation is. Let's see, 2025 current expectations, $2.95. Okay, so $357 by 2.95. That's where you get that multiple of 121 times. And I think roughly we could stay at about 120 times, even as interest rates come down. Could you see that multiple go up? Obviously, during a raging bull market, you most certainly could, but it's not guaranteed. Based on the current estimates for 2026 earnings, which by the second half of this year we're going to be focusing on, $3.87, would put Tesla stock at about $468 per share or so by the end of this year. About $100 of upside, not too crazy. But what if I told you that licensing deals of FSD entering the Chinese market, Optimus being used internally at Tesla, all of these things mixed with interest rates coming down and less promotional activity at Tesla is going to raise EPS, okay, for next year. And perhaps the expectation is not $3.87. It was $4.22 1 month ago for next year's expected earnings. But what if expected earnings hit $6 or $7 for 2026? then you're at an $847 stock. And that's where I could kind of see things playing out by the end of next year, where earnings expectations actually go higher. Tesla gets more profitable, right? And there's obviously many other reasons for this. The refresh Model Y should have higher margins, among many other things. So that's kind of why I still think Tesla is going to be a $900 stock by the end of this year. And again, I know it sounds absolutely crazy, but to me, it sounds logical, just given what I'm seeing out there in the marketplace today. Now, short term, Tesla could fall to this 100-day moving average around $332 per share. But as some have said on X, rightfully so, have pointed out, Tom Nash says Tesla's negative sentiment plus the 6% drop makes it very attractive right now at $370. They said that yesterday. Real Blonde Broker says, if you're selling Tesla in the 350s instead of buying, my best guess is you'll be chasing soon. Check its seasonality. So, again, kind of agree with that. Let me know what you guys think down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.